Good afternoon, everyone. It is September 11th of 2023. This is Robert Rayburn here at Life Pro Asset Management. And before we get started, definitely want to take a moment to remember those who lost their lives on this humbling day 22 years ago. And not just the people who lost their lives on that day, but all of the men and women who fought for this country after that date. Obviously, before and after this date, but specifically tied around September 11th and the missions that our military went on to, really at the end of the day, deliver justice to those who carried out the events and try to reshape the world a little bit to make those events less likely in the future. So we continue to thank those and obviously remember with great humility what happened on that awful day 22 years ago. It kind of feels like yesterday that happened. But aside from that, let's go ahead and get started with the presentation. As has been happening over the last 5 or 6 weeks, the market remains in this corrective phase, right? Digesting some of the gains that we experienced and saw in the months of April, May, June, and the first half of July, and really just going through a period of digestion. But underneath the surface, we're seeing sort of this civil war breakout underneath the surface of the stock market, where there are certain areas of the market that really are breaking down and have pronounced and important points of weakness. And we want to pay attention to that and understand what that means for the macro landscape. What is the market trying to tell us? But then also look at the other side of the equation. There are areas that are working. And then understanding how the stock market is composed, right? If some of the areas that represent larger weights of the market are areas of pronounced weakness versus those areas of strength that may be smaller, you may see the market as a whole be weak, but knowing that if you look carefully, there are areas to make money. So that's a big theme that we've been talking about for the last few months. We got to pick our spots. It's a stock pickers market. It's a sector pickers market. And we want to make sure that we're not just blindly saying, hey, we hate or love the market. There's many facets of different areas of strength and weakness underneath the surface. So the three big things for this week are consumer stocks. They continue to break down. The breadth of that weakness continues to spread out. Number two, energy stocks, on the other hand, are breaking out. You can kind of tell where we're going with this. Energy does tend to come at the expense of the consumer and vice versa. So with that, in addition to that, commodities also look pretty cheap outside of energy. And then lastly, that Apple perimeter, which has been sort of this gatekeeper of technology and the overall bull market, that perimeter has been breached. And we've seen some important sell-offs and distribution days in Apple. And we think that's more emblematic of certain themes that are taking place across the wider macro and stock market landscape. So we're going to review all of that this week. So as it relates to the S&P 500, I think a few things that I would like to point toward here is we had this initial high in mid-July. The stock market then went through about a 6% pullback or correction, whatever you want to call it. And then we rallied, right? And then we hit another peak, but this peak was lower than the prior peak. And then we sold off again. Now we've had a little bit of a rally here, but I think it's important to understand when we're understanding where the market may be going, we want to look at and gauge where were those prior highs. Are we making higher highs or lower highs? And then looking at the lows, right? Are we looking at lower lows or higher lows? And we're sort of at this apex moment where, depending on what the market does next, if we sell off again, then we'll have an important clue as to whether we breach the prior low or we hold at a higher level, or if we rally, whether it will be another failed rally with an ensuing downturn. So a lot of this is more S&P level type of market gauging and symptomatic gauging, measuring the symptoms of the market. And a lot of it is we're just waiting for the price action to tell us what might be ahead. The one thing I would note is that the amount of net 3-month highs that the individual stocks are making underneath the S&P 500 continues to fall, right? So we're seeing more and more weakness So we're seeing weakness spread basically underneath the surface of the S&P 500. And a lot of that has to do with weakness in the consumer, weakness in the banks, weakness in utilities and consumer staples. So we'll focus on that. And those are areas that we're really actively trying to avoid and largely have avoided. We added a little bit of technology exposure this week in terms of just like what we call orphaned tech stocks, where the valuations are actually quite attractive. But aside from that, we're obviously very heavily overweight into areas such as the commodity world and other areas that we like as well. So a few things that rally did fail around 4,500. And the center of all this weakness is the consumer. And I think that's an important theme and why the consumer may be weak. So when we look at the strength and weakness and the performance breakdown over the last 1 month and 3 months, what's interesting is in the last month, almost every sector is modestly red. The only thing that's not is energy at 4.5% and technology X FANG stocks. So X those Facebook, Apple, Netflix, Google, Tesla, et cetera. So when we strip that out, tech is largely flat. Energy up 4.5%, while every other sector is, I don't want to say deeply red, but sizably red for a 1 month performance time period. We look at the last 3 months, energy is up 10.7%, and then we see modest gains for some of the other sectors, and then some red with utilities, REITs, and staples. And I do want to point to that because the defensive part of the market, the utilities, the staples, the REITs, they're not showing any signs of pronounced leadership that you would expect if we were going into a recession. But some of the more economically sensitive areas, such as consumer, is showing strain. So I think we're just in this sort of the way the market is behaving is a market that is suggestive of stagflation, right? So not a recession, not hyper growth, but also you want to be in areas that can do well when inflation is stubbornly high. And energy fits right at the very top of that. And you can see that here. Since the CPI print hit that 3% low point in July, energy of all sectors has actually been the leader by leaps and bounds, 9.8% versus tech at number 2 at 1.5%. Why do we like commodities so much, aside from the macro environment, is that they are just so incredibly cheap, at least appear to be incredibly cheap relative to history. So when we're looking at commodities relative to the Dow Jones, again, right here near a, call it 120-year low. And commodities tend to trade up and down into these bands, and these valuation bands relative to stocks. And when you get into this lower band, you kind of want to close your eyes, buy some commodities, whether it's energy, whether it's copper, whether it's iron ore, and then, just be patient with it. And you tend to, historically, at least anyway, tend to have pretty decent returns once you're in these price levels. The other thing, of course, is this area can help consumers make money if other sectors are facing headwinds, right? So one of the things we want to look at is if a certain area is doing well, what is that coming at an expense toward, right? So if energy is doing well, what's that hurting? Well, it's naturally going to hurt the consumer, right? So again, just something we are trying to pay attention to, the clues that the stock market is trying to give us. The other area is energy's assuming leadership. And I think this is an important development in the market. We've talked about this month in, month out for the better part of 4 or 5 months. We are a little bit early. Now it's starting to come into fruition. We look at the energy stock. We look at the this is the price of oil. This is a rounded technical bottom, a flag formation that is forming right here. And we expect to break out above 90. Brent crude, which is sort of the crude oil, how it's priced outside of the US, is already breaking out above that $90 price point. We see no reason why WTI won't follow suit. And we look at the US stocks in terms of the SPR, the strategic oil reserves. Again, we're back all the way to 1980 levels. That's important because up here, when we were at record highs in terms of the strategic oil reserves, it was okay for the US to say, hey, we're going to tap into that, try and push oil prices down. We think this was a temporary band-aid when the Biden administration did that. The problem now is the bills got to be paid. The energy market is still tight. And if you get a China recovery, if you get India accelerating, if you get a durable US economy, the US government can't come in and bail out the consumer. They can't throw out, if they did the same type of inventory release that they did up here, we'll simply not have any more reserves left. So this is something the market, I believe, is starting to catch on to. This idea that the bailout for the consumer does not exist this time around. And the Saudis know that. And the Saudis, regardless of what our political stance or our client's political stance is, we know for a fact the Saudis are no fans of the Biden administration and certainly would not like to see them reelected. I think it's interesting knowing that, and then looking at what they're doing in the market right now, and that is continuing to cut production with that stated goal of getting prices to about $100 a barrel. That happens, that's not good for the Biden administration and some of those reelection chances in 2024, because that certainly will press up the price of retail gasoline and could really start to reinflate the market as it relates to some of those inflation indicators. And we know that's taxing on the consumer, right? So when we look at consumer discretionary stocks relative to energy, they were vastly outperforming energy stocks by the magnitude of 20% year to date. Just a couple of months ago, consumer stocks have largely given back all of that relative year-to-date performance now. And you can see this is a broad breakdown relative to the consumer, or sorry, relative to energy stocks. And we didn't include it this week, but you see the same thing on the technology side as well. So the two market leaders of consumer stocks and technology, both breaking down relative to energy stocks here in the month of August and now in September. And to sort of prove this point, we wanted to say, well, what are some of the symptoms we're seeing at the individual stock level from some of those bellwether stocks that we pay attention to on a daily basis? So LVMH, Louis Vuitton, right out of France, a huge breakdown, 20% sell-off in Louis Vuitton. It's been a luxury market leader as it relates to stock market performance. Its performance relative to the French market. Again, we see a broad pullback there. Apple, the king, right? You want to label a stock the king somewhere, it's Apple. And, you know, when kind of anecdotally, when you start to hear anyone say that a stock is unassailable or there's no weaknesses, that's usually a decent sign that no risk is being priced into a stock, and that any news that is not perfect news could be perceived as bad news, and you see those risk premiums move up, which leads to the stock price coming down. And we think this is a very important technical top for Apple. Huge sell-off, about a 12% sell-off, which is big for Apple, earlier in August on high volume, a retracement rally at a much lower level from the previous high, and then another big sell-off this week on the news of China bans at the government and state-sponsored company level in China. Again, whether or not that really means a lot fundamentally, this stock is one thing, but when a stock is priced to perfection the way Apple is at north of 30 times earnings, it actually does mean something, because Apple's really not growing a lot because it's already so big. So when you get some of these notional weak points that start to come to the surface, or bad news items, the stock can really get hit. And people realize then, hey, why is this thing priced at 30 times when I can buy all these other stocks that are available at 8 times, 9 times, 10 times earnings like you can in the energy space? And it's not just Apple or LVMH. You see in Restoration Hardware, a significant sell-off on earnings this week. Again, rally to the top, big sell-off, failed rally, so a lower high, and then a big sell-off. So if, again, we go back to Apple, very similar pattern. Big sell-off, failed rally, and a big secondary sell-off on that failed new high. And then we look at Target. I mean, I would think, you know, when I look at my wife's own spending patterns and her friends' spending patterns at Target, I think, oh man, things are great. But they're not. and Target is increasingly under pressure. And that is one of the big bellwethers of what I would call the upper middle class of the US. And you can see here close to a 52-week low for Target and showing no signs of recovery at this standpoint. So the bottom line, ladies and gentlemen, is as the current stock market correction continues, we're looking for signs of emerging leadership and some of the sectors that are losing out as a result of that emerging leadership. So what's working, what's not working? First of all, energy is working. Energy, we believe, will continue to work. We think this is a secular shift away from tech and consumer and toward energy. We think energy is got a multi-year runway ahead of itself. Now, will there be corrections along the way? Absolutely, right? That will question our thesis? Absolutely. But supply continues to fall and demand remains resilient. And we think that the sector, especially when you look at the valuations, in many cases, single-digit PEs, is just incredibly attractive at this point. The weakness in consumer stocks appears to be spreading, right? So it started with like the dollar stores and Target, and now has spread to other areas like the Restoration Hardwares of the world, the LVMHs, the Apples, something we want to continue to pay attention to. And then lastly, commodities as an asset class appears to be historically cheap. We favor that area. We continue to look for opportunities there. So this is what we got for you this week, 888-543-3776. Please feel free to reach out to your advisor. We're here to help, and have a fantastic week. Thank you.